Hello and welcome to episode 280 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leakes. Damien, welcome back. How are we doing?
Good. It's been an exciting week, hasn't it? Because we've been doing a lot of work with the new website. So the end of last week, as we mentioned on the previous podcast, we launched the new Money to the Masses website. We've had a lot of people testing it. We've been making changes to it, and it's looking really good. So
it's looking sexy.
It is. If a website can look sexy, Andy, it looks sexy. So I'm so pleased with it and how it's been received by people within the Money to the Masses community. And we can see, obviously, looking at the back end, the impact when people use the website, how they engage with it even more. So that's been fantastic, because obviously when you do these things, you're launching something and you never quite know what's going to happen when you unleash something into the world, and you hope it's going to behave in a certain way. So it's great when you have a project as big as this, that it goes as well as you hoped it would do. So that's been brilliant.
It's been really good getting feedback from, like you say, the testers. And thank you once again to those. They'll be getting a mug. They know who they are. And in fact, it sort of inspired us and made us think that it was such a success. I mean, some of them were tiny editorial points that we wouldn't even notice, even from looking at the website ourselves. So these things will only get found out when we've got a team of people that are helping us out. So it made us think about maybe doing once every 6 months, something like a bug hunt. That's right, isn't it, Edmund? Where we would ask people to go out and find these issues and we'd reward them for doing it.
Yeah, because it's like, if you think about Wikipedia, those things are crowdsourced in terms of how they're monitored, edited and things like that. And we have a great community, and it can be they just find a broken link here or there. And it's those sorts of things that over time just creep in, and it's great for finding those things. I mean, we obviously are on it at Money to the Masses to make sure that we keep any errors to a minimum. But you've got to realise we've got over 4,500 articles on our site, and some of them are lengthy. So there's always going to be things that change, and it could be third-party products that we refer to, or articles and other sites that we refer to may have moved or broken links. So it's great to have those people around. And of course, one thing to mention, we are expanding our editorial team, which is another exciting thing for Money to the Masses. So don't be surprised to see some of that on our social media channels. There's already been on there this week. And so if you do want to work for Money to the Masses and join Andy and the rest of the team, then do keep an eye on our social channels.
And also, Damien, that's a really good point. I'm going to put a link to the careers page on the notes from this website, so people listening to this that are interested in maybe working for Money to the Masses can see what opportunities there are and come and work for us. I mean, that is exciting, right?
That is exciting.
Okay, so what have we got coming up on this week's pod?
So the first piece is going to be an investment piece. Now, I'm always looking to expand my knowledge. Everybody should. So I read a lot of books and articles, and one of them is something to do with turtle trading. And it's almost like an urban myth that occurred back in the early 1980s. And the term turtle trading is not trading the animals, but it was a challenge that occurred. It sounds like something from a Hollywood film where a very successful, incredibly successful trader put an idea to the test that he could teach anybody to become an incredibly successful trader, trading and making millions of pounds.
Sounds like the film Trading Places.
It is based. There is an argument that there's a lot of debate whether Trading Places, I've not actually seen the film, but it's a lot of debate whether Trading Places inspired the project, the experiment, or it was the other way around. And there's a lot of debate on that. And so I'm going to talk about this experiment because there was a book I've read that talks about this, the turtle trading. The turtles was the name given to the group of traders that
were green, that were new and didn't know what they were doing.
Exactly.
Right? Yeah.
And there's some incredible lessons to learn from it. So I'm going to go through that. The next piece I'm going to talk about is based upon the idea of 1 step forward, 2 steps back. And whenever we do things with our money, and even me personally, sometimes you do something with all the best intentions and the correct reasoning behind your decision, and then sometimes you undermine it because we're only human by doing something else that undermines completely the positive move you took forward. So I'm going to go through some of those just to put them out there, some that we've experienced ourselves, and hopefully get people to think around the 2 steps back that they want to try and avoid. And the reason I want to do it is because if you can avoid those backward steps, it means the forward steps you take have a much bigger impact. And the last piece is a piece that I'm going to hand over to Andy to do. It's based upon something Jordan, who's our almost resident coupon kid at Money to the Masses, has done another article for us, and it's based upon some research that he's carried out.
Yeah, so the piece that Jordan's done this time round is on cars and which brands of car hold the best resale value when you come to selling them on. So if you're thinking of buying a new car, if you were thinking about what that car might be worth in a few years after you've bought it, I mean, that might not be your biggest buying decision, but if resale value is a top priority of yours, we're going to tell you the top 3 car brands in terms of resale value and also the bottom 3. The ones you should steer clear of.
Okay, so I'm going to go straight into the investment piece this week. So the turtle trading idea, as I mentioned, was based upon an experiment that happened in the early 1980s. Now, there was a very successful trader called Richard Dennis and his trading partner, William Eckhart. And William Eckhart and Richard Dennis were commodity traders. And Richard Dennis in particular, he appeared on one of these almost rich lists. So there'll be very famous investors like George Soros, people might know of him. So he's like up there with Warren Buffett in terms of the all-time great investors. And it was almost a rich list in terms of how successful they are and the money they were managing. And on that list appeared this chap, Richard Dennis. And Richard Dennis, by all accounts, and I'll refer to the book title at the end of the piece so people can go and read more. According to the biographies, he was very unlike all the other people on that list. So he was much more liberal. He was from a background that was basically self-taught. He took $5,000 and turned it into $100 million.
Wow.
That shows you the scale of his success. And the other people on the list were people who were pretty much from the typical background that you'd expect traders in the 1980s to be. So it would have been somebody who was probably privileged from a wealthy family or from a financial family of some kind. There was a history in trading money, had gone to particular universities maybe. But Richard Dennis was slightly different. He was a kind of guy who would dress very casually, would drive an old beaten up car. This is even at the period when he was incredibly successful. So he didn't display all the trappings of wealth once he became a success. Now, I'm not going to go through his whole history of how he came about. I mean, his dad, for example, would have been considered just working class in the 1980s. So the type of job, he wasn't into investing or anything like that. So this guy took Wall Street by storm. And people were amazed about what he achieved. And they're also intrigued because, as I say, he'd come from a background, humble beginnings, but became incredibly successful. And the way he'd become successful was effectively by following a trend-based system. So a trend-following system, a bit like momentum. And we talk about that sometimes on the podcast. I mean, 80/20 Investor, for example, has that built into its algorithm, its core. So he had a trend-based system that he would follow. So he would make very big bets and he was renowned for it and he would produce some incredible results. But also along the way, there would be some large drawdowns. Now, what was interesting is between Richard Dennis and his trading partner, William Eckhart, they had a bit of a debate that went on for the best part of a decade. Richard Dennis, who was incredibly successful, believed that what he did could be taught to anybody. He felt it was rules-based, not allowing your human behaviors to become involved, emotions, and you had to keep to a process. Whereas William Eckhart believed that Richard Dennis was basically a genius. He had something innate in him. And traders at that time, and a lot of people probably still now, believe that some people are just great investors. They're great traders. And they have something about them that makes them be able to see what's going on in a market, decipher it. A bit like the Matrix when at the end Keanu Reeves sees all the numbers and it forms he understands it. Richard Dennis didn't believe that. So what happened is they decided to run an experiment and they put ads in the Wall Street Journal. And I think there was a whole host of other papers they put them in around the US. And now you have to think this was the pre-internet. So they put job ads into these papers asking for people to apply to learn the secrets of Richard Dennis and his investment firm that was incredibly successful. He was going to teach them how he made money and they were going to trade his money for them and they were going to keep a percentage of the profits themselves, but he was going to give them the money to invest big. And of course, that would attract a lot of people. I mean, it's quite an inviting proposition, isn't it? You don't have to have a particular background. He was after a real eclectic mix of people. He had to try and prove his point. If he could prove it, have people from all walks of life. He didn't want people who were Wall Street veterans or who'd come from that particular background. If he could really genuinely teach anybody, he had to have anybody in that list. And the sorts of people that came through, they had a process to whittle them down, but they end up having a security guard. There was a lady who was met in a bar. There was quite a mix of people. There were some people who had a financial background, but from the story, most of them didn't. Now, this story had a bit of an urban myth about it because it occurred, but it wasn't something that was really publicly out there. It was between the two traders, Richard Dennis and William Eckhart. But of course, over the decades, there have been rumours and odd articles written about what had occurred. And the reason that the articles then came about, or people started to wonder what had happened, was because when those rich lists were produced in time, some of the people he had taught appeared on those rich lists. And to give you an example, two of the people who were on that first training course, the people he was teaching, earned more than 175 million in only 5 years. So the group of people were called the Turtles, and the reason they were called the Turtles is because he went to Singapore, Richard Dennis that is, and saw the turtle farms, and he took the idea, could he create a turtle farm of traders? Knew nothing, turn them into stars. So the evidence is that it worked. The people had a 2-week course, which was strangely actually run by William Eckhart. So he was the guy who thought that it was nature rather than nurture caused you to be a good trader. He actually did the teaching of a lot of the courses and a lot of Dennis's secrets into how to trade. But if you look at the evidence that's out there, it suggests it did work. And now there's a book I will tell you is called The Complete Turtle Trader, and it's written by a guy called Michael Covel, Covel, and he analyzes the story of what occurred, but also what the trading methodology was, because that's really what's interesting. If they could teach somebody to become a successful trader, what was it that they taught people? And go and listen to the book, because you can get it on audiobook or read it. I will warn you, it's a little bit Hollywood. The guy clearly wants to have a Hollywood movie made out of it, and he even says it in the book. So there's a lot of that element where you get these US documentaries you see on telly where they start the story and then they go back and they cover the bit just before the break again. It's got a lot of that, and you can just whittle through it. What happened is that the experiment was clearly successful. There's a bunch of the traders who became very wealthy afterwards. I mean, they were investing Richard Dennis's money, so he also became wealthy out of it. And what happened after that is the reason it went into urban myth is there were a lot of people who were trying to close down the story of what occurred, because they personally might not have wanted the story to come out because they might have been one of the turtles. They might have been part of the experiment in other ways. There were people who obviously didn't succeed as well. And the book follows some of those stories. And I think some of the stories that have been probably published since then are not necessarily always nice about all the characters that were involved in this strange experiment. So what I want to run through is just quickly what the basic rules that they traded on were. So they had two trading strategies. So there was a short-term one and a longer-term version. So what they would do is they would look for breakouts, and a breakout could be either up or down. So it could be the breakout in a share price. So in the short-term strategy, they would look at the 4-week price high. So if today the price was at a 4-week high, that would be a signal to buy in. But they always knew their exit. And what they would do is they would look for a 2-week low and they would exit at that point. So if the price hit a 2-week low, they would look to exit. And as I say, this breakout pattern could be up or down. So we'd use those patterns to either be long on the market or be short. On a longer time frame, they used an 11-week period. So they would look for a breakout. So that was either up or down over an 11-week period. So was the price of the stock, well, they were trading commodities at an 11-week high. If it was, that was a potential buy signal. But then they would reverse their trade when they hit a 4-week low point. So that was a 20-day trading period. So that would allow them to know when they would get in or out. But they would also apply filters to these to try and increase the odds of them getting the correct breakout, because obviously not every time you get some form of breakout would it be sustained. So they were going into every trade. The key thing is they knew when they were going to get out. And the reason they did it was to try and preserve capital. So they made lots of investments, and they would never invest more than 2% typically of their total pot on any investment. But they would know when they were going to get out. So they were trying to preserve capital, the downside. So it meant that they were making lots and lots of trades, and lots of them might not actually succeed. They were stopping out. They had a stop loss. They would jump out the market when it started to get the bet wrong. Knowing when you're wrong has been probably one of the biggest things that's undermined most investors, that they bet on something and they keep chasing losses. But what these guys were stopping out. So they were jumping out when they got it wrong. But then when they got it right, they were doubling down on it. They were putting more money. If the market kept moving in their favor, they would bet again on the market. They would invest again. They were even using leverage at times. But the other thing that they were doing as well, they were mapping what the market had been doing. So they were looking at ranges. So, looking at a share price, for example, it moves within a range in a particular day. They were looking at those ranges over an extended period of time, say 20 trading days. So what they were getting was a sense of the way the market was moving, a kind of a sense of volatility. And they were using that to predict where the market would potentially go and the ranges that you could possibly be between going forward or on that particular day. And they would use that, therefore, to dictate when they would also enter or leave the market or the size of their stake, because they could reduce it from below that 2% level if they wanted to, if they thought the market was showing signs of volatility. So they would also, in volatile markets, they took less risk and they also put less money to work. In very flat markets or less volatile markets, then they would decide to put a bit more money to work. So imagine like a boat. If you've ever been on a jet ski or a speedboat, if you're in a choppy sea, you go a bit slower because you don't want to crash and fall off. But on a flat, windless day, you put the throttle down and go for it. That is the analogy of what they were doing. And they were using a measure to try and work out what that range is. Now, there's a lot of debate about whether these systems would work today. And there was an example where somebody invested $10,000 at the start of 2007 and they had $25,000 by the end of that year. Now, obviously, if you know history, it was around the financial crisis. So that was pretty good going, but they were suggesting that the system still works. The world moves on. Things do change. So it'd be interesting to see if it does generally work now. But I have seen a lot of people in America, hedge funds, for example, who use variations of something like this. So they will work out ranges. So they'll look at the range that they predict that, say, the S&P 500 could trade between. And they might, therefore, when on this range, say it was between, let's use an example, they might say on a given day it could trade between 3,000 and 3,050, depending on where it is in that band, that range will dictate whether they go bullish and put more money to work, or they actually take money off the table and even maybe potentially sell out their positions completely. It's interesting because it suggests that Richard Dennis's system does have some validity still today. So what the lesson is that being good at investing can be taught. People who think that you're either good at it or you're not are kidding themselves. And actually, that's probably what's helped the financial services sector and Wall Street and everybody be able to keep people investing with them, because private investors can invest, retail investors can invest, and they can do so successfully. But the key points to take away, if you want to try and get into trading, it's worth having a read of the book just to get to understand, if nothing else, the idea of building the process. Because what they did is they kept testing their process. They also understood how many trades it took them to make money. And by that, I mean, they would typically probably get at least half of the trades wrong. But what they worked out was that they knew the percentage of trades they would get right, the percentage they would get wrong, but they also knew the amount of money they typically earned when they got it right and the amount that they lost when they got it wrong. They obviously controlled the amount they lost when they got it wrong, as I described earlier, with things like stop losses and keeping an eye on the prices to the downside. But what they did was therefore focus on trying to increase the average return when they got it right. So that equation, that expectation, it was more about not how often you were right, but how right you were when you got it right. And by keep analysing the data, they kept going back over, looking at the trades they got right, understanding when they occurred, and trying to improve their system. So therefore, they maybe tighten some of the ranges to make sure they were screening out some of the identified trades that weren't going to work or didn't work. They could screen them out to try and improve their process going forward. That is what we all should be doing if we're trying to invest. So we look at when we get things wrong. And of course, this is for people who are taking more of an active role in their investing, not investing just purely in a buy and hold mentality with a passive ETF, for example. You've got to be objective and look at how many times you get things right, how many things you get wrong, what sort of behaviors you have. And it's interesting because when I make my changes to 80-20 investor, I mean, I've never heard of this story before we developed that idea of 80-20 investor. But there are a lot of synergies between what they did in that and the ideas of 80-20 investor. For example, I'm obviously not a successful investor like these guys, but I don't focus on the price I buy in on a fund. And I will make a decision to get rid of a fund based upon criteria to do with trends. So I won't sit there and think, well, I'm going to sell this at a loss and that will keep me up at night. I will then just move on to the next trend. It's the way I personally do it. And the success that I've had is based upon that. Otherwise, if I kept holding things and banking on them going back up once they've gone down, then I'd probably be sitting on huge losses like everybody else would do if they just kept holding on to losing investments. So there you have it. The key to investing and being successful at it is process. Whatever your process is, you have to understand it, you can build it, you can adapt it, but you have to keep repeating and stick to it. And the one final point I'll just add, Richard Dennis, he would produce some incredible results, but also, along the way, there would be some large drawdowns, because when you're following trends, there are times, or when you're making investments, there are times where you will get it wrong. And of course, when he was being aggressive with bets and he was really pushing hard, there would be times, like I was saying, that analogy of when you're on a speedboat on a nice calm day, that the weather will change and suddenly they could almost have a crash. And you have to be able to stick with a process and through it. And taking that lesson, it's amazing how many times when we have a market crash, people want to bail out. And we had one in February. So this is true for even buy and hold investors. A number of people who go, I want to quit. This is getting too choppy. The thing is that investing is the ups and downs. And if you stick with a process, you have to be brave enough and bold enough to stick through it, to stick with it through those periods of drawdowns. And the research, I mean, I've done some research on 80/20 Investor looking at the market, what happens when the market crashes over the last 30, 40 years and how long it takes it to recover. The evidence shows if you stick with it, that you will be rewarded. But that's not easy, and it's not for the faint-hearted, which is why people like Richard Dennis, who are able to stick with it, who are bold enough, have become incredibly successful investors.
So that book is The Complete Turtle Trader by Michael Koval, and an extra bit of homework for you, Damien. Go and watch Trading Places.
I will do.
There's a lot of synergy in what you've explained here and what I've seen in what is one of my favourite films, I have to say.
I've never watched it, so I will go and do some homework. But it's an interesting insight, and fundamentally the message is also that I believe that anyone can learn to invest. It's not mythical. You just have to be patient and stick to a process.
Okay, so we're moving on to the next piece, which is talking about finances and that sort of situation you find yourself in where you think you're moving forward, but you're kind of treading water and sometimes moving back. It's one step forward, two steps back. And there's a few examples we're going to give and some takeaways on how to stop that.
Yeah, I mean, this comes about when during the coronavirus period, we're always trying to make changes to our finances, or I was trying to improve things, look at stuff that we spend our money on and just to refine everything. It was a good period for where we all could do that, living that lockdown lifestyle and trying to take it into the future. And there are a lot of lessons that we've all personally had about our money and how we use it. But it got me thinking then about just life more generally, how there are so many examples of where you do one step forward and people start off with the good intention, right? I'm going to do the right thing with my money. Like we've all come out of lockdown. I'm going to start to do something, but their behavior undermines that. So I'm going to give you the first example. People have learnt the lesson of why we need emergency funds. So the lockdown period, coronavirus, and people have lost wages and jobs and everything like that. Having an emergency fund, so anywhere between 1 to 6 months earnings. I mean, 6 months is ideal, even longer if you can afford it. Saved up in an easy access account can help you through periods like we've had recently. If you can't have that, then obviously you want to be able to have some access to credit. So you want to have no debt. And this is the key part. There are a lot of people who have debts. And I used to do this. Everybody's done it at some point, where they start to build up a savings pot, but they've got debt. And that is one step forward. So you've realized that you need to build a savings pot for whatever reason, but you've got expensive debt. And it's the message is that you are paying to save. So if you're earning, you will be lucky if you're even getting 1% on an easy access savings account. I mean, there were some out there that were being pulled in the last couple of weeks, but you could be paying 18, 19% on your credit card in terms of interest. So that differential is huge. So you're effectively paying to invest. What you should do is pay down your debt and clear it. Because as I say, I know you might feel better about having that access to an emergency fund, but what you're also doing, if you start to clear down your debt, you're freeing up an element of your credit limit that might be able to be used if the worst happens again. So you will be able to use that credit limit. And so pay down debt with savings. So we go one step forward, but not 2 steps back. We're trying to make the most of those forward steps. Leading on from that, is one that, again, I fell foul of, and we talked about it in the office, is that when you start to try and clear debt, so we've sat there and thought we want to clear debt, and during the coronavirus lockdown, the level of debt being repaid was almost unprecedented in the UK, and it's been replicated in other countries. So people have sat there, they've been saving money, they maybe not been spending as much on going out, on travel, commuting, and they've used that sensibly to start to clear their debt. The problem is if we then take that forward and you think, well, we've set up an idea, a plan, we're going to pay down our debt, but if you're still spending on your credit cards at the same time, then that undermines what you're doing when you're paying down debt. And it's one step forward again, and in my view, and 2 steps back. Because when we talked about in the office, we've all basically experienced a period where we were starting to pay down debt, but actually we were then still using it for purchases. And then we found ourselves at the end of a particular period of time, we had more debt than when we started the exercise. So the idea of one step forward, we'd actually taken 2, 3, 4 steps back. So if you can, you really want to cut up credit cards. You don't want to be using credit cards. The other one is, again, we focus on debt at this beginning part. You're going to start to pay down debt. Make sure you're using the idea of snowballing debt. So you try and move your debt around. So you get debt onto 0% credit cards where you can, so you're not paying any interest. You then pay down the highest interest bearing credit card first, and what happens is a snowball effect. You can find out more on the website if you go and have a read around. You start speeding up the rate you pay off all of your debt. So there's a plan. Of course, if you don't have a plan and don't do it in the optimum way, then it will take you longer to pay it back. So you'd be doing one step forward, but ultimately taking a step back on that journey to being debt free. Another one on credit cards is credit card points and cashback. Now, there are a lot of people who use credit cards for the cashback element. And I know people who sit there and will go, oh, I've saved so much on cashback, or I've made so much on cashback from using their credit card. So what they do is they don't use their wage to spend their money in a month. They just go out and pay everything on a credit card. Then at the end of the month, they then clear the credit card. So they're not charged any interest, but they've collected the points. You can rack up some really serious points or air miles. We did a podcast on it. But to give you insight, I don't personally do that. I don't go down that road, and people will be sitting there thinking that that's quite foolish. I'm aware of the benefits of obviously using those credit cards for the cashback element. But the reason why I'm nervous of them is the 2-step back principle. Because I know that if I keep trying to maximize my points, really it's an enticement to try and spend more and more to get bigger and bigger rewards.
Which is kind of how they're designed from their sort of perspective, I suppose.
It's exactly, isn't it, Andy, how they're designed to try and get you to the point where you can't clear it at the end of the month. And then you've got into that trap. You've now started to acquire debt. Now, there's not to say I do the idea of spending on credit cards to clear them at the end of the month. That is always going to be the way I would do it. But I don't obsess about the points, because I think I start to chase them. And for me personally, it's just a mental thing that comes from decades ago when I had credit and used to use a lot of credit and had to pay it back, is that I just think that I'd rather be heading forwards rather than potentially be having a couple of steps backwards somewhere down the line.
I personally do use the cashback credit card, but only recently since moving house. And I am nervous about it. I'm not 100% sold on it. I like the fact that I am earning cashback, but me, like you, Damien, have had issues with credit card debt in the past, and I don't want to be back in that situation. So I'm still not 100% comfortable with it, but I'm enjoying the cashback element.
Yeah, I mean, I think it's brilliant. It's absolutely sensible. It makes sense to do it. It does, to get those rewards. It's free money.
But I always feel I'm one big purchase away from being back where I was before. And I don't like walking that tightrope. So if you're like me, then perhaps you need to think about.
And so for me, I then started using more things like Quidco and the cashback sites that are out there to get cashback that way.
Yeah.
And I know people go, well, why won't you get the credit card cashback at the same time? Yes, that's true. But I'm just thinking in my journey, I want to keep moving forward. And so in that instance, I'm not getting into that realm of temptation. I'm earning cashback through maybe a cashback website. Jordan would be very proud of me. I know he's always banging on about using cashback sites he did at the event. But at the same time, I'm not going to end up getting myself into any more debt. One of the others I think is budgeting. Okay. So people will build budgets. So it's one step forward, a massive step forward to be able to build budgets or quantify their spending. So we need to get people to quantify. If you can quantify, you can control it. And I liken it to when we were at school. Do you remember the days when people were at school? Well, probably still do it now, maybe. I don't know. You drew up a chart on the wall for your revision chart. And I don't know if there's anybody who ever successfully followed their revision chart on the wall to be able to pass their exams. But I would make it and it'd be really colourful, it'd be brilliant. And you then just, it was within 48 hours. It was basically redundant because I hadn't stuck to it.
Yeah, mine was gone before I'd found the blue tack to tack it up to the wall.
You spent the day designing it. And these guys here would tell you, I'm one of the world's worst procrastinators. I really am. So that sort of thing for me would have been, I would have spent too much time building that chart. So what I want people to do is they take a step forward. They might build a budget. They might look at their spending and they realize where they can make changes. But what they don't do then is the 2 steps back is they don't review what they did at the end of the month. So they set a budget. I'm going to only spend X amount maybe on food or on travel or whatever it is. And then they get to the end of the month and they've got no money still, but they then don't do that review part, which is where that would keep them moving in the right direction. And the way to get around that I've found is I'm a big fan of the tech stuff that's out now. So some of the apps that are out there, there are a number of them. If you go and look on the website, ones like Emma, for example, that can do a lot. They do only the quantifying, but they help you control a lot of what you do in life in terms of your spending. They'll tell you when you're going to go over your budgets. A lot of the banks now, some of the app-only banks have a lot of this built into them. And I really like it because it helps you to keep taking a step forward without taking the 2 steps back, because there's nothing more demoralizing when you don't hit a budget, it goes out the window and you just think, I can never get over this. So it's not a budget, it's a spending plan. Remember that. The other one is direct debits. Now, I've always been a fan of paying by direct debit on certain bills. And the reason I've done it historically has been because it protects my credit report. Nothing worse than not paying your credit card bill. You're going to decimate your credit report. And I've therefore set up direct debit so it will pay the amount that you need to pay on your credit cards or whatever bills. Now, there are some bills I pay annually because it's cheaper to do so. And they tend to be some of the insurances out there, things like home insurance, car insurance. But if you have direct debit, so you've taken that step forward, you know what? I want to make sure that I pay all my bills. I can afford to pay them, but I want to make sure I do pay them. The danger then is we get into this world where we have a load of standing orders and direct debits that just sit on our account and money gets taken away and we end up not having any money at the end of the month and we don't realise why. And again, we talked about in the office about these like old direct debits that could be lurking in your account. It might just be a few pound here or there, but we don't review them. And so we need to go back and review them, because you can sign up, direct debit. I don't want to default, direct debit. And you can get yourself into this direct debit madness where you then go and look at your account and you suddenly realise, well, what are all these direct debits for? Where is my money going? Almost by stealth. Could be standing orders or whatever. You need to keep a control on that. So review those. Go into your banking app now and go down all those standing orders and have a look and see if you know what they all are, and then question them if not. Again, some of these apps out there, if your bank isn't the best online, they can help you do that, and they show you how much your bills are. The other thing is some of these now show you how much the bill goes up each month. So if your direct debit increases, it will tell you, it'll alert you that you paid £1.50 more this month on your phone bill than you did last month. That is the sort of thing that is brilliant. By stealth, you end up paying more money if you have direct debits than you might realise, but these things can keep control over it. Another one is, I've fallen foul of this again, I fixed my energy bill. So I've fixed my energy bill, reviewed it, decided on the product I want, happy days, I can forget about it. But that's the danger, I then forget about it. So I've taken one step forward, but then I end up on their standard rate a year down the line or so, because I've not put in my diary the date that the fix comes off. So if you fix anything, whether it's a savings rate, whether it's a bill, you need to put in the date, a reminder that you need to go and review it and then maybe change again. Now, they will notify you, but like most people, you probably won't read half of the stuff that you were sent. So the way around that could be you put a date in your diary or use some of the auto switching services that are out there. I like some of these auto energy switching services. There are a number of them. If you go on the website, if you search for auto switching services, in fact, Andy will put a link on the episode on the website to some of the reviews that we've done of them. They are very good, and they can help you save on your energy bills. I'm going to rattle through a few more because I could be here all day. People who are going to try and buy a house together, maybe they're a couple, they decide that do you know what, we're going to save for the future. They might start taking out a joint savings account. That's great. One step forward. We're going to start to deliberately put our money together. We're going to pool it to try and buy this house that we want. The problem is, if you do that and you aren't aware of your other half's credit report, you become financially associated. And that can be negative for you. If you've got a great credit report and a credit history and they've got a dire one, that can be negative. So it's one step forward, but then two steps back. The ability potentially to be able to buy that house might go further away from you. Similarly, if you were a couple and you split up, you might have done that scenario. You might be deciding to have a joint account, to maybe you've done that and you were going to buy a house at some point in the future when you stop renting together or something like that. You have to realize that you want to become financially disassociated. So again, you've taken the positive step to move on with your life, but then you could also hamper it still in the future if you don't make that change early on. And there's been people who've written to me who've had made decisions where they want to move on with their life, but they haven't made those financial disassociations or separated their finances. A few more. If you run a business, let's say you're a director of a business, of course, there is the ability to pay yourself in dividends, and people will do that. So they might pay themselves a small salary in dividends, and that might have the benefit of obviously reducing their potential tax bill. But that is great, but when it comes to you wanting to try and get a mortgage, it does make getting the mortgage a little bit more tricky. It's not impossible, but there is a general rule of thumb that I've found to hold true, and mortgage brokers I spoke to have said the same thing, that there is this view that if you are going to run your own business and you're going to be a director of it, you might try and mitigate tax, but you're also going to probably hamper your chances of getting a mortgage or make it more difficult, limit your options. So it's a trade of which do you want? Do you want to pay less tax? Or if you're going to try and get a mortgage in the future, is that going to be more important? So make sure you are aware of that before you decide what you're going to do. Investing, I mentioned earlier, so you might decide to invest. You're investing for the long term, but then as soon as it gets tricky, as it did in February, they might decide that they don't want to invest, or they become beholden to the market or what people are saying on the TV. Investing for the long term means you're going to end up having periods like this. So you've taken one step forward. I'm going to invest for the future, but you take two steps backwards if you can't accept the level of volatility, the downs and the ups. Make sure you have your investments in line with your attitude to risk. Another one is if you get a will. So you get a will for obvious reasons why you would want one, but then you don't review it in the future to make sure it's still okay. So you've done the good positive thing, but let's say, for example, you then get married, you need to then make another will because it will negate the one you've already got. Another one quickly before I'm going to get into spending actually is that getting married is wonderful. Okay, so people get married and they do it for the right reasons. It might be sort of emotionally, whatever, but there are implications of getting married that people have to be aware of. So it can be, for example, one step forward in terms of you personally, but financially it can be two steps backwards. Now, if you end up having a relationship where you owned things previously and you then become married and then that relationship breaks down, then it could be the case that you're actually far worse off as a result of that. So people need to bear that in mind when they make decisions. I know that makes me sound like a real grump, but it's only because I've seen it, and it does happen where people, for example, maybe have a family before they get married and they get married to somebody and then things don't work out and then actually financially are in a worse position than when they entered that marriage. So that's something to bear in mind. Right, we're going to touch upon spending. I could be all day on these things. This is me to a T. I've become obsessed with the way I spend money. So I look at it in terms of what I spend, not what I saved.
Yeah.
So what happens is the bog off, buy one, get one free. All of these things are there to entice us to buy more than what we actually want. So what happens is we all go out and we will be enticed to buy things and they'll be 40% off and how much money you saved. But what we should be focusing on is how much we've spent, because what happens with all those offers, they encourage you to buy more than you need and you end up spending more money than you were meant to. So you took one step forward, you saved a lot of money. Great, your money's going further. But the two steps backwards is you have spent more money than you ever intended to and have bought things you might not necessarily want. So always focus on what you spend. I do. I think my wife drives her insane about the fact that I'm always thinking about how much I actually spend rather than save. But when you do, what happens is you tend to actually spend less money.
And that's a really interesting one, talking about your wife there, because my wife and I have had this thing about petrol and petrol prices, because I'm of the opinion that we'll just head to wherever we need to get the cheapest petrol price. But my wife points out, and I hate admitting she's right, she'll often say to me, but it takes 20 minutes to drive the other side of town to save 2p on fuel. And I'm saying, yeah, but we'll save £2 by doing, I think, £2 every week. And then you top that, it's £100 a year. But she's absolutely right. 20 minutes in the car, the extra petrol that we're taking to get there. If you work out your hourly rate, how much effort it is to do it, and the wear and tear on the car on doing so. So the one step forward is, yes, I think I'm saving 1 or 2p, but the 2 steps back is the wear and tear on the car, the extra stress and time. And I hate to admit it, she's right. So if you're doing that, you need to evaluate whether that 1p a litre is truly worth it.
Yeah, I mean, unless you get some of those offers at the supermarkets.
Yeah, the 5 and 10p off. Now that's probably worth a
litre.
Yeah.
I mean, I've done that, but I used to, years ago, I did used to look at the petrol. There's a website, it's called petrolprices.com, and they tell you where the local prices are, cheapest ones.
Hey, look, if you're heading past 4 petrol stations, then absolutely go ahead and pick the cheapest one.
Yeah.
That's just common sense.
I before we move on to the last piece talking about cars, I did that the other day. I thought I knew what the current going rate for petrol was, and it obviously changed with oil prices and that moving quite
There's a
radically.
big disparity at the moment.
So I felt like the do you remember the Play Your Cards Right game? And I was going down a road and there was 4 petrol stations, and I was like, no, we won't go to this one because that's expensive. So I drove past it. My wife said, no, I think that's a pretty good price. So I kept on going. The price went higher, and then it went higher, then it went a little bit lower, and in the end, I ended up paying more than if I'd stopped at the beginning. It did feel like that game show, and I basically lost out. So you do need to know what the price of petrol is at the moment. Good, right. Moving on to our last piece, Andy. You're talking about cars, something that I know nothing really about. I am, in terms of knowledge, it's like a void in my life, and to be honest with you, I'm quite happy about that.
I mean, what a segue. Petrol prices into a segment about cars. We couldn't have done any better than that. Yeah, I know what you're saying, Damien. I'm not massive on cars. I don't know why we're even doing a piece on cars, to be honest, because neither of us are really qualified to do this. But it's why we've got Jordan, our resident expert, on all of these kind of things, who's gone and done a piece on cars and looked at which car brands hold the most value when it comes to selling them on, and which car brands depreciate the most. We're going to go on to the top 3 and the worst.
Top 3, hit me.
We've got a ton of listeners now that's either going to be absolutely delighted with their purchase or absolutely devastated with what they've got. So here we go. The top 3. Surprisingly enough, Mini comes out top in terms of the best car in terms of resale value after holding on to it for between 3 and 5 years. You'll only lose around 45 to 50% of the amount you pay when you come to sell it on. Now, that sounds a lot. We all know.
But you lose about 20% as soon as you go off the forecourt.
We've all heard that, haven't we? You lose 20, 30% as soon as you drive off the forecourt. To be honest, that's pretty much true. So, yeah, you'll lose about 45 to 50.
I once knew somebody who wrote a car off driving off the forecourt. So he lost a lot more than that, yeah.
The next car you might want to consider if you're buying a new car in terms of resale value is Audi. That came out second. And again, you're going to be looking at between 45 and 50% loss after 3 years.
So these are the brands. So the cheapest. I can see there on your list, the Audi A1 hatchback is their cheapest brand. So if you want to buy a cheap Audi, that's the car to go for then, is it, to hold its value?
Yeah. So after 3 years, you're looking at a £20,000 car. That's going to be worth around £10,000 to £11,000 on resale.
And the third brand, Andy?
So in at number 3 is Volkswagen. They tend to hold good value. Again, good German manufacturer. So that's up there in the top 3. And now moving on to the bottom 3. All of those people that have got only one of these cars are going to be absolutely devastated. I think you've had many of these cars.
I'm going to say, Andy, this is almost proof that I don't know anything about cars, that I actually own the first one on that list, Peugeot. I can see it. I had nothing but problems with the Peugeot that I had. And, Peugeot is, sorry, Andy, I've just stole your thunder there, but Peugeot's the list.
Yeah, Peugeot's on there. Basically, from what we're seeing on this list, French cars aren't particularly good. So Peugeot are up there as the worst, and also Citroën are up there as another car brand that you kind of want to avoid. If you want to listen, if you're a fan of Citroën or Peugeot and you like how the car drives and you're not worried about the sell-on value, then well and good. It doesn't matter, does it?
And what's the other brand?
The other one is Fiat. Try and avoid a Fiat. The Fiat 500C is one of the most popular small cars around. You see absolutely thousands of them on the road, but apparently If you buy one at around about £15,000, after 3 years, you're going to get a 75% drop off. It's only going to be worth just under £4,000. That's massive depreciation.
That is massive. There you go. See, I know nothing about cars, and I'm proud of that, Andy. But you can't know everything, can you, to be honest?
You can't. So that is it. We're done for this week. If you want to get in touch with Damien, you can do so. Damien at moneytothemasses.com is the email address. Twitter, it's at moneytothemasses with the number 2. Don't forget to check out Instagram and YouTube. Please do drop us a review. You can do that on iTunes or your podcast app of choice. And of course, don't forget to join our community group if you haven't already done so. Facebook.com/groups/money to the masses. And for everything that we've chatted about on the podcast today, as always, check out the New Look website, moneytothemasses.com, and click on podcasts, and you'll be able to see all the notes from the podcast.
Yeah, and the latest episode is always shown on the homepage. At the foot of the homepage, you will see a section, and you can even play the episode directly from the homepage of the website. But then if you want to find old episodes, there's a link below that player. You can find all the previous episodes.
Right, that's it. We're done for this week. Damien, you're off to watch Trading Places. I'm off to see how much my Nissan's worth. And we'll see you next week.
Until next time.